You were told the 30-year mortgage is the American dream. You were told owning your home means freedom. You were told paying it off is the finish line. All three statements are designed to keep you locked inside a system that extracts wealth from you for 3 decades while making you believe you are building it. The 30-year mortgage is not a path to ownership. It is a rental agreement with the bank where you pay double the price of the house and they keep the deed until the very end. This is not financial literacy. This is financial capture. And by the time you realize it, you have already spent 15 years funding their profit model. Every month you make that payment, you are told you are building equity. But in the first 10 years of a 30-year mortgage, over 70% of every payment goes straight to interest. The bank gets fed first. The house gets paid last. You're not buying a home in those early years. You're renting money at a price that doubles the cost of the asset. The average American will pay $250,000 in interest alone on a $300,000 home. That is not ownership. That is a subscription service to the illusion of ownership. The system is built to feel like progress. Every statement shows your balance going down. Every year you get a little closer to that magical number. But the math is designed to keep you running on a treadmill that moves faster than you do. In year 5 of a 30-year mortgage on a $300,000 loan at 6% interest, you will have paid over $96,000 to the bank. Your principal will have dropped by less than $34,000. That means $62,000 vanished into interest. The house is still almost entirely theirs. You just spent 5 years paying rent to own a piece of paper that says you might own it in 25 more years. This structure is not an accident. It is the direct descendant of land contract schemes perfected in the early 20th century, when working families were sold homes on installment plans that front-loaded interest and made default almost guaranteed. The seller kept the deed. The buyer kept the debt. If you missed a payment after paying for 10 years, you lost everything. The modern mortgage cleaned up the language and added federal backing. But the mechanics stay the same. You do not own the asset until the final payment clears. Until then, you are a tenant with a maintenance bill. Here is what they do not tell you when you sign. Property taxes will rise. Insurance will rise. Maintenance will cost more than you budgeted. The payment stays fixed, but the total cost of keeping the house does not. Every year, the hidden expenses grow while your income might not. The bank sold you a monthly payment you could afford. They did not sell you the compounding cost of keeping the asset they technically still own. The average American homeowner spends an additional 30 to 40% on top of their mortgage payment just to keep the house operational. That is not ownership. That is an expense with no exit. And if you try to sell before the 30 years are up, the system makes sure you pay again. Realtor commissions take 6% off the top. Closing costs take another 2 to 3%. If you sell in the first 10 years, the amount you have paid down barely covers the transaction fees. You walk away with almost nothing while the bank has already collected a decade of interest payments. The house appreciated. The market moved. But your slice of that gain got eaten by the cost of entering and exiting the game. The system is designed to punish early escape. Stage 1 is the excitement. You are approved. You are getting the house. The bank tells you that you qualified for more than you thought. They show you a monthly payment that seems manageable. The interest rate is locked in. Everything feels like progress. This is where the trap opens widest. The emotional high of approval makes you blind to the 30-year clock that just started. You are not thinking about year 15. You are thinking about moving in. The excitement is the drug. The loan is the needle. Stage 2 is the normalization. 6 months in, the payment feels routine. You have adjusted your budget. You have accepted the new baseline. The bank statement comes every month and you glance at the balance. It is going down. Slowly, but it is going down. This is the psychological anchoring phase. You have internalized the payment as part of your identity. You are a homeowner now. You stop questioning whether the math makes sense because the routine makes it feel inevitable. The payment is no longer a choice. It is a fact of life. Stage 3 is the realization. 5 years pass. You look at the amortization schedule for the first time with clear eyes. You see how much you have paid. You see how much went to interest. You see how little the principal moved. This is the moment the map reveals itself. But by now, you have spent 60 months inside the system. You have furniture. You have roots. You have neighbors. The cost of leaving feels higher than the cost of staying. The trap does not need locks. It needs inertia. Stage 4 is the doubling down. You refinance. The bank offers you a lower rate. They offer you a chance to pull out equity. They offer you a fresh 30-year clock. You take it because the monthly payment drops and that feels like winning. But what you actually did is reset the interest front-loading. You just gave them another 10 years of payments where 70% goes to interest. You thought you were getting out. You just went deeper in. The refinance is not a rescue. It is a restart. Stage 5 is the lifestyle lock. 10 years in, your income has risen. Your career has progressed, but so has your cost of living. The mortgage is the anchor. You cannot move for a better job because selling means losing money. You cannot downsize because the market you are in has appreciated and everything else costs the same or more. You cannot walk away because your credit is tied to that payment history. The house is not an asset anymore. It is a cage with a mortgage statement. Stage 6 is the end game. You are 55. The house is almost paid off. You have 15 years left. The payment is still the same, but now your income is flattening. Retirement is visible. The house has appreciated, but you cannot access that value without selling or taking out another loan. The thing you spent 3 decades paying for is still not liquid. It is a pile of wood and drywall that you cannot eat or spend. You own it on paper, but the market owns its value. The system got 30 years of interest payments and you got a structure that costs money to maintain and cannot be converted into cash without another transaction fee. This is the finish line. You are holding an illusion. The business model is simple. The bank loans you money at a rate that guarantees they collect double the home's value over the life of the loan. They secure the loan with the house itself, so their risk is almost zero. If you default, they take the asset and resell it. If you pay on time, they collect 30 years of interest. If you refinance, they restart the clock and collect again. Every move you make inside the system feeds them first. The house is the bait. The interest is the trap. The 30-year timeline is the guarantee that you will pay far more than the asset is worth. In the 1930s, the federal government standardized the 30-year mortgage to stabilize the housing market after the crash. Before that, most home loans were short-term with balloon payments at the end. The new model spread the payments out and front-loaded the interest to make sure banks stayed profitable even if borrowers defaulted early. It was designed to protect lenders, not buyers. The system was built to make home ownership accessible, but accessibility came with a price tag that doubled the cost of entry. You got the house. They got your income for 3 decades. In the 1980s, mortgage-backed securities turned your home loan into a tradable asset. The bank that gave you the loan sold it to investors. Your monthly payment became part of a financial product that generated profit for people you will never meet. The loan is no longer a relationship between you and a lender. It is a commodity. You are not a homeowner to them. You are a revenue stream. The system industrialized your debt and made it profitable at scale. The longer you pay, the more valuable your loan becomes to the market. Your struggle is their yield. In the 2000s, subprime lending proved the model could be pushed even further. People who could not afford the payments were sold adjustable rate mortgages that exploded after 2 years. The banks collected the fees upfront and sold the risk downstream. When the defaults hit, the banks got bailed out and the borrowers lost their homes. The system survived, the people did not. The lesson was clear. The house is not the product. The loan is the product. And the loan is designed to extract maximum value regardless of whether you keep the house or lose it. You are in stage 3 right now if you have been paying for more than 5 years and just realized how little principal you have knocked down. You are in stage 4 if you refinanced in the last 3 years and felt relief at the lower payment without calculating the extended timeline. You are in stage 5 if you feel stuck because selling means losing money and staying means another 15 years of payments. The map is not theoretical. You are standing inside it. The only question is whether you see the walls. Here is the math they do not show you at closing. A $300,000 home at 6% interest over 30 years costs you over $640,000 in total payments. That is $340,000 in interest. You paid for 2 houses and only got one. If you had invested that $340,000 in an index fund averaging 7% annual returns, you would have over $1.3 million after 30 years. The opportunity cost of the 30-year mortgage is not just the interest you paid. It is the wealth you did not build because your money was locked into servicing the debt. Property taxes compound the extraction. The average American pays 1.1% of their home's value in property taxes every year. On a $300,000 home, that is $3,300 annually. Over 30 years, that is nearly $100,000 in taxes. The house appreciated, so the taxes went up. You are paying rent to the county on an asset you are still paying the bank to own. If you stop paying property taxes, the county takes the house. If you stop paying the mortgage, the bank takes the house. You do not own it. You are leasing it from 2 landlords at once. Insurance is the third extraction layer. Homeowners insurance costs an average of $1,500 per year and rises every time the risk models change. Over 30 years, that is $45,000. If you are in a flood zone or fire zone, add more. If you have a mortgage, insurance is mandatory. You cannot opt out. The house must be insured because the bank's collateral must be protected. You are paying to protect an asset that is still mostly theirs. The insurance is not for you, it is for them. Maintenance is the silent killer. The rule of thumb is 1% of the home's value per year. On a $300,000 home, that is $3,000 annually. Over 30 years, that is $90,000. Roof, HVAC, plumbing, foundation, appliances, everything breaks. Everything costs more than you budgeted. And none of it is optional. The house does not care that you are still paying the mortgage. It decays on its own schedule. The maintenance cost is a second mortgage that never ends. Add it together. Principal and interest, $640,000. Property taxes, $100,000. Insurance, $45,000. Maintenance, $90,000. The total cost of owning the $300,000 home for 30 years is $875,000. You paid nearly 3 times the purchase price. The bank got rich. The county got fed. The insurance company got paid. You got a house that costs money to maintain until you die. This is not wealth building. This is wealth extraction with a deed at the end. The silent phase is the decade between year 5 and year 15 when you think you are making progress, but the math shows you are still mostly paying interest. Most people realize they are trapped during this phase but feel too committed to escape. The house feels like home. The neighborhood feels like community. The mortgage feels like identity. But the numbers do not lie. You are still renting from the bank with a maintenance bill attached. The system relies on one trick. It makes you feel like you are winning because the balance goes down. Every statement is a progress report. The finish line is visible even if it is decades away. This feeling of progress is the drug that keeps you inside. You are not measuring opportunity cost. You are watching the balance shrink and calling it winning. The progress is real. The price is hidden. The alternative is not renting forever. The alternative is understanding that the 30-year timeline is the trap. 15-year mortgages exist. They cost more per month, but cut total interest in half. On that same $300,000 loan at 6%. A 15-year mortgage saves you over $170,000 in interest. You pay $470,000 total instead of $640,000. The house is yours in half the time. The bank gets half the profit. Paying extra principal every month breaks the amortization curve. If you pay an extra $200 toward principal every month on a 30-year mortgage, you cut 5 years off the loan and save over $60,000 in interest. The system allows this, but does not encourage it. Every dollar you pay toward principal is a dollar they do not collect in interest. Accelerating payoff is your only leverage inside the system. If you are in the system now, here is what you do. Look at your amortization schedule. See how much interest you have left to pay. Calculate what happens if you add extra toward principal every month. See how many years that cuts off. Then do it. Every extra dollar toward principal is a dollar you take back from the bank. The trap depends on you following the schedule. Break the schedule and you break the trap. If you are not in yet, do not sign a 30-year mortgage unless you plan to treat it like a 15-year by paying extra from day one. Buy less house. Pay it off faster. The goal is not to own the most expensive structure you can afford. The goal is to own something outright as quickly as possible so your income is yours again. The system wants you leveraged for 30 years. Your job is to get out in 10. If this opened your eyes to the cage you are living in, subscribe. Because in the next video, we dismantle the rest of the illusion.